Hi, my name is James Clark and I lead the risk advisory practice for SAS in Asia Pacific. I'm delighted to host this session today on green and sustainable finance. I'm joined today by Michael Monteforte and Gemini Yang from KPMG. Michael, Gemini, would you care to introduce yourselves?
Yeah, sure. Thank you, James. So, Michael Monteforte, I'm a partner with the KPMG Financial Risk Management Advisory Team in Hong Kong. And Gemini and myself have been working with a number of banks in this market, as well as globally, on the topic of ESG, but more specifically climate risk and how climate risk might impact many different areas within risk for banks. Gemini, you want to introduce yourself?
Thank you, James and Michael. So I'm Gemini Yang, also from the same team as Michael. I'm also a partner from our team. So I think for the past years, we are very happy to work on a lot of hot topics together with the banks and the other financial institutions. And since last year, ESG, green and sustainable banking, and the climate risk management has been one of the hottest topics. So looking forward to sharing with everyone more during this session today. Thank you.
Thank you very much. And let's dive into the first of 6 questions for the panel. So the first question is, what types of approaches have you seen with regards to HKMA's pilot stress testing requirements, specifically in relation to Pillar 1 risks and the ICAP? Michael, do you want to go first on that?
Yeah, so look, for the benefit of our audience, I think what we can do is just give a very brief overview of what the regulator here is actually looking for. I guess back in the middle of 2019, the Hong Kong Monetary Authority publicly came out with their Sustainable Banking and Green Finance Initiative. And basically, they've got 3 pillars there. They're looking at green and sustainable banking, which is what we're talking about today, which also encompasses climate risk stress testing. The second pillar is around responsible investment. And the third pillar is trying to create the ecosystem so that Hong Kong really is a center for green finance within Asia as well as globally. So if we dive a little bit deeper into the first pillar, which is the green and sustainable banking, there's a few things that have brought us to where we are today. So the first thing that the regulator did was introduce a common assessment framework, or a baseline, let's call it. And they also started that off by running a series of surveys or questionnaires that the banks had to complete with regards to their own progress on green and sustainable banking. The second thing they did is release or gather a set of pilot banks to conduct what we're going to be talking about today, which is under certain scenarios, how would the impacts of climate risk be transmitted and impact the bank's capital position, P&L, et cetera, et cetera. So that's really what we've been focused on. We're working with a few institutions here on how to develop all the mechanics and models so that under different climate risk scenarios, banks can estimate what the potential losses might be for credit risk, market risk, op risk, which also then leads into the ICAP. And my colleague Gemini is very versed because she's really getting the hands-on leadership with some of the clients here in terms of implementing the climate risk stress test. So I'll let Gemini talk a few minutes about this topic.
Yeah, sure. Thank you, Michael. And I think from Hong Kong May, the guidance is quite clear. So they would like the banks to stress 2 sources of the climate risk, which are physical risk and the transition risk. And also, Hong Kong May has clearly set out their expectations on the risk factors to be stressed. So, James, you are correct. So, Pillar 1 risk, credit, market, and operational are the focused risks expected from Hong Kong May, and especially for credit risk. So, all the major risk factors like probability of default, PD, and also loss given default, LGD, and of course, the aggregated ECL impact and also eventually the RWA are all expected to be assessed under both sources of the risk types, physical and the transition, which will bring very big challenge to the banks because originally not all the banks have the models in place to assess all these major risk factors, and now there are totally brand new scenarios coming from the climate risk perspective. And if we look into the details, let's take transition risk PD as an example. So originally, usually the banks stress the PD according to the changes of the macroeconomic factors, but now the scenarios are coming from the climate changes, like either extreme weather under the physical risk or some market-wide activities driving some transition activities under the transition risk. So to transmit all these variables to the risk factors, so the banks need to consider something different, like what we have observed from the Hong Kong communications and also the market communications. We would like to share one approach, which is a good balance of both technically modeling and also the coverage or granularity of the specific analysis, which is a combination of bottom-up borrower level analysis by each company, and also with the top-down approach, sector level analysis. Because Hong Kong may already assessed some high carbon sectors, which we will talk through more later, and for all these sectors, so the banks now actually can set up their stress testing approaches quite clearly, like step 1, to set up their own scenarios, like leveraging the Hong Kong given scenarios, leveraging the NGFS scenarios, and to generate the bank-specific scenarios. And then step 2, to consider how to transmit the scenarios variables to their bank's internal financial portfolios. Like from the bottom-up approach, the bank can consider to conduct 101 bottom-up approach analysis to assess the financial figures impacted by these climate variables. And of course, from the top-down approach, the bank can either consider to leverage a model approach like the merge model or another simply calibration approach. And of course, step 3, to translate all these impacts to a financial impact, and then all these financial figures can be leveraged as the input to the bank's internal rating models or scorecard, and then we can link together the climate scenarios and the financial models. So this is a typical approach leveraged by the Hong Kong or the Hong Kong local banks to stress transition risk. But if we look into physical risk, it's another different story, because physical risk looks more on different portfolios compared with transition risk. So it's not talking about high carbon portfolio again. It's talking about the direct damage coming from the extreme weathers like typhoon, storm surge, etc. So usually Hong Kong would expect the banks to stress their property-related, closely related portfolios like the mortgage loans, of course also coming from both commercial mortgage and the retail mortgage, residential mortgage part. So for this part, usually the banks need to find out a proper damage curve to assess how to value the negative damage to the property values. So here we can share high level usually a physical risk model would also consider 4 parts. Firstly, also related to the scenario setting up, which is called by the climate variables extension, which like for Hong Kong local banks, they are now looking into the historical extreme weather and the damage data from the Hong Kong observatory, and then step 2 to build a hazard model to capture all these weather's impact to the bank's portfolios. And of course, the step 3 would be the construction of the damage curve itself, and the number 4, build the connection between the disaster or damage curve model to the financial models, can link all the damages of the collateral values to the climate risk factors like PD. So this would be a typical approach used either by transition risk or physical risk. And Michael also shared stress testing is only one step expected by the regulator quantitatively assess the climate risk. Actually, climate risk management, including more components. And all these components will eventually be leveraged by the bank's overall enterprise risk management, ERM, of course, also including ICAP. Because we can see from the Hong Kong Made stress testing program, all these stress impacts are coming from the pillar 1, 3 risks, will all eventually assessed by the impact to either the overall P&L atom, which will coming to the final capital base, or to the impact of the RWA, so which is also the numerator and the denominator of the CAR ratio, capital adequacy ratio. So CAR ratio is also the same purpose as ICAP. So we can see there will be a very close relationship. So far the detailed guidance from the regulator is not released yet, but some banks already considering to either enhance their existing risk appetite to further incorporate a few metrics capturing the climate risk considerations. Or some banks are also considering to enhance their credit approval policies to better cooperate with the new stress testing results, which are all related to the application of the stress testing results. So this would be my brief sharing on the typical stress testing approaches for both transition and physical risks, and also the potential linkage with ICAP.
Thank you for sharing all that detail with us, Gemini. So the emphasis here is on the Hong Kong situation. Of course, regulators elsewhere, both out of Europe and in ASEAN, have also been putting their climate risk agendas forward. And I think it's fair to say there's quite a lot of consistency in the high-level approach that supervisors are taking, as well as banks' response. So let's move to the next question. So the pilot that's being run by HKMA is likely to be a significant learning curve in many respects for organizations. Will the exercise produce useful results? Michael?
Yeah, that's an excellent question. I think if you look at what's happening in Europe, the French and the English authorities have really pushed what they call their participating banks or their pilot banks to develop very detailed stress testing methodologies for climate risk, whether that's through scenario expansion, probability of default migrations, transition risk. So you really see a big emphasis from the European regulators for the banks in Europe to do this exercise at a very granular, detailed level. They're looking for all kind of things related to identification of climate risk in the portfolios, client-specific location data, so for collateral and real estate, so you can simulate the impact of physical risk. They're looking for banks to even develop some of their own scenario explanations. Some banks that we heard of in Europe are actually using satellite data to understand the impacts of climate risk on various different topography and geographies. So that's what's happening in Europe. Now, if you look what's happening on the ground here in Hong Kong, the regulator, at least from my understanding, has also pushed banks to really put a lot of effort on data, methodology, putting resources in. But I think my personal view is that maybe the banks are kind of overemphasizing a bit on the modeling and maybe missing a little bit of the bigger picture about what they really should get out of what I call these generation 1.0 results is more of like a heat map to understand directionally which type of exposures, which sectors, which counterparties are the most impacted, as opposed to modeling this out to the nth degree. The other thing I would say is that going forward in the future, there's going to be a lot of back and forth and more generations 2.0, 3.0 of these kind of climate risk stress test models. So I think really the spirit should be of the first generation, not to focus on the most accurate results, but really to understand the direction. Because given the challenges that banks are grappling with, there's going to be a lot of limitations in the results, right? Particularly given it's a tight timeline. And we'll talk a bit about more specific challenges later on. But I don't know, Gemini, if you wanted to add anything when it comes to the limitations of the first round of results on climate risk.
Yes, I totally agree with Michael. So the banks may need to admit that the version 1.0 stress testing program can never be perfect, no matter from the approach wide or the data wide. Like on the approach wide, we already can see for either transition or physical risk, the banks have to make a decision what are the priorities they would like to include in their very first version of the program. Like for physical risk, there may be several types of extreme weathers like typhoon, and even for one certain type like typhoon, there are also several damage channels, like either by extreme wind, by the power of wind can also bring the damage to the property, or by the storm surge. So both can damage the property directly. So that of course the banks, if they have sufficient resources and sufficient time, they can analyze all these damage curves one by one, but it's not possible due to the regulation timeline. And also they need to admit that the priority more serves from like a roadmap, like a heat map, so they can, according to the first round of results, and consider the focus of their next steps. And for transition risk as well. So Hong Kong has placed very clear expectations to the DSIPs. So they require the DSIPs to stress the bottom-up borrowers one by one to cover at least 30% of their overall portfolio. Some of the non-DSIPs are also trying to stress more borrower level corporate portfolios, but still, so one by one financial figure analysis would be very challenging on both data, like to assess the corporate transition channels accurately. We need to collect the financial figures not only from revenue, also from the expense, and then we can capture the calamity risk impacted perspectives, like the policy changes due to climate change, or the new technology, or even the market sentiment. So all these are the ideal and the complete approaches that banks can consider to evolve in the coming years, because climate risk is looking to a much longer period until end of this century. So the banks, still have longer time to evolve their models, and of course the data is also need to match with the model complexity and also the coverage. So this is also something the bank is working on. So we already observed these limitations from both model approach and the data side.
Great, thanks for that. And both of you have pointed to the complexity of trying to model physical risk and the sector impacts. And I remember the 2011 Thailand floods. The sectors and companies primarily impacted there were the car and the electronics manufacturers. not because of damage to their own premises, but because of disruption to the supply chain. And this implies some kind of contagion risk that needs to be taken into account. I'm interested in your views of which sectors you think are going to be most impacted when we do this analysis in Hong Kong, given that it's a center for international finance.
Yeah, I think, look, to be upfront, I don't really have a view yet in terms of which sectors would be the most impacted based on the kind of climate risk stress test that we're running. I mean, if you look at this from a PRC government point of view, I mean, they've got policies in terms of which industries they're asking, kind of the state-owned banks to shy away from for various different climate-related reasons. But I think we're still in the process of working through that with some of our clients. But Gemini, I don't know if you've probably seen a few from your recent work that you're doing in the market.
Yes, I think originally most of the Hong Kong local banks would think the high carbon sector don't impact their portfolio significantly. But when we look into the details, actually we already identified several high carbon sectors like energy. Most of the Hong Kong local banks have large exposures to the big names. Some of them are the energy companies based in mainland but listed in Hong Kong, so they had their loans with the Hong Kong local banks. And the utility, of course, all the local Hong Kong utility companies are also will trigger the high carbon business related businesses. And for metals and the mining, it's really there are also some portfolios identified in the local banks. And of course, for transportation, Hong Kong do have some large transportation related companies like the MTR or the airport or even the auto road related companies. And of course, there are also the other two sectors, property development, construction. There are several big names in Hong Kong on these sectors. And the last one would be manufacturing. So it's also, but for this sector, it's mostly coming from the mainland companies listed in Hong Kong. So all these 7 sectors serves the first batch of expectations from Hong Kong May. But of course, they also encourage the banks to look into more sectors like agriculture, hotels, etc., which may potentially impacted by the carbon emission.
I see that there's an interesting question that came up, which is asking, do you think there is a risk of supervisors focusing too much on stress testing? I think maybe we can just provide our own view on that. I think maybe, because if you look at a bank, if you look at the balance sheet and the P&L asset liability, the overall direction should be on the business strategy for a bank, right? And setting up the governance structure that includes some type of environmental and social governance over everything that the bank is doing, which could include on the asset side, the type of products you offer, sustainable financing, sustainable assets, refinancing of sustainable investments, pricing and risk. You've got consideration of all of these climate and ESG risks into the capital process. But the other side also has to look at what's happening from the investors, right? So I think the regulators can put pressure on banks to do things, but I think the other pressure is going to come from the investor side. And there's been a few news stories that have come out recently around Bank of America, around HSBC, where investors are starting to ask more ESG related questions. So I think the pressure is going to come from multiple angles. And stress testing, to be honest with you, I think it is important so that banks can identify which exposures are sensitive to climate risk. They can report it and they can mitigate it. But ESG as a broader topic is there's a lot of things going on, and I think the stress testing is hard. And I don't think I think banks, if they focus too much on that, they may lose sight of the bigger ESG, initiatives that's going on globally.
I would agree with that, Michael. And from a software vendor perspective, we're also trying not to lose sight of the importance of scenario analysis more broadly from a business perspective rather than regulatory driven. And of course, scenario analysis is a critical tool for running any business. But the capability, which has been born primarily of responding to regulatory stress tests, is probably not as well developed as it could be given modern technology and tools. And that probably segues nicely into the next question, which is around the challenges from a practical perspective of embarking on these climate risk stress tests. What do you see as the main challenges that banks will face? Gemini, do you want to do that one?
Yeah, I think we already shared a few of the limitations or challenges previously. Maybe let me only summarize very quickly, maybe 3 points as the takeaways. Firstly, the challenge would be the missing data. And secondly, so which related to the first one, related to the data limitations we went through just now. And the second one would be the adjustment of the approaches. Like the banks used to be familiar with the shorter term forecasting models, like at most 3 years for the capital planning and the ICAP program. But however, this time for climate risk stress testing, we are looking to the impact until mid of this century or even end of this century. So the models can also be considered about this new challenge of the longer horizon, and also the new assumptions and all the new, even the overlays, all need to be considered for this new approach. The third takeaway would be the interaction between the historical data and also the hypothetical climate risk variables. So sometimes the scenarios from both physical and the transition are maybe too severe and less possible to already happen in the past. So sometimes how to better leverage to derive the useful information from the past historical data, and also to be leveraged in the focusing model based on the hypothetical scenario would also be another challenge. So 3 points from me.
Yeah, if I could add on to that, I think with all of the things that banks are grappling with right now, you have COVID, operational issues due to COVID, you've got LIBOR transition, Basel IV, just to name a few. Now you're throwing on very complex climate risk modeling requirements. I see as the big challenge is people skills, manpower. And as a matter of fact, we just got an RFP about 45 minutes ago from a very large global bank asking for, a pretty large request in terms of manpower to support their climate risk rollout globally. So as a big challenge I see is people and skilled people to work on this topic of climate risk. The second thing I would say or reiterate is the data. We have clients that are trying to use GPS data to assess the proximity of their physical collateral to sea line or seashore, right? Because in Hong Kong, one of the key impacts is due to storm surge during typhoons. So the closer the collateral is to the shoreline, the higher probability of sustaining a physical loss to that property. But if you think of the business of banking, when you collect information about a piece of property or plant and equipment, you may or may not have databased the actual address in the systems. You may or may not, right? And then even if you did, then trying to figure out the proximity to the shoreline is another challenge. Another issue around this data challenge is for properties that are at a higher level, like, here in this market, you've got a lot of high rises. Now, storm surge would tend to impact the properties that are lower, right, closer to ground level. So again, that's another data element that you need, because if you've got, Hong Kong is a market that is highly collateralized by residential and commercial property. Well, those properties that are closer to the ground level theoretically should have a higher, susceptibility to storm surge damage. So again, that's just another data element you would need when you're trying to develop these things. So I would say that's just a few of the challenges that's shaking out of this initiative.
So Michael, we got a question a little earlier asking whether there were any other climate-related macroeconomic variables that you see being introduced into the modeling process, in addition to the ones that you've already mentioned. Do any come to mind?
Well, I mean, you've got all the carbon. Yeah, exactly. I mean, so I have been, obviously the two of us are reading a lot about this, and there is a list of different variables that, but nothing is coming to the top of mind. I guess I don't know if you have any besides the carbon and the pricing and the.
And also another one would be very interesting, the energy mix.
Oh, energy mix. Yeah, energy mix, right.
But still, the major drivers are still either carbon emission limits, the quota. There was already the policy regulating the carbon emission quota in mainland, and some Hong Kong companies are also.
So I think we've lost our colleagues from KPMG temporarily. I assume the team is going to try to get them back.
Are we back?
We have you. We have you again. Yes.
Okay. So James, yeah, maybe back over to you. And any other questions from the audience, or final thoughts or questions you want us to answer?
Sure. I think we have time for just one more question. So let's turn to something that's fairly practical. You've talked about the business of banking, and at the end of the day, that's what the banks are there to do. So when it comes to the more qualitative aspects around this exercise, what type of changes in loan policy or loan origination processes do you think will be implemented during 2021?
Well, look, I think theoretically, like a lot of the large global banks have already incorporated these concepts of green banking and ESG into their loan policies. Even 15 or 20 years ago, banks would have brown lists or certain sectors or counterparties that would need additional levels of approval in order to conduct business, whether it be for reputation risk purposes or environmental purposes. Like it could have been a company that had a big environmental incident, et cetera, et cetera. But now that this whole ESG thing is in full swing, we're talking to banks, or banks are coming up with plans to re-engineer their entire loan origination processes to incorporate ESG. And that starts with credit assessment. So, now besides, AML and risk and onboarding, now you need to incorporate this dimension of environmental risk into your loan policy. So things around credit scoring, your PD and LGD models need to incorporate maybe some environmental factors. So the first step is credit assessment. The second thing is around limit setting. So banks will need to, or they're starting to think about how they update their limit grids to incorporate environmental factors, right? And risk appetite as well. The third thing is around concentration risk and the need to set up concentration limits, whether they be industry, geography, right? So which parts of a certain geography are more susceptible to climate risk, and you need to have a limit for that, as well as processes to link the concentration limits back to your risk appetite. The other areas around credit approvals. So banks are thinking about updating their approval processes to account for ESG risks that could include product design, enhanced due diligence when you're lending to large corporates on ESG, loan application processes or documents need to be updated, as well as approval authorities. The fifth thing is around loan monitoring and provisions. So once you have these other areas set up, then you need to have a process in place to monitor, which could include early warning indicators for ESG and other kind of risk characteristics related to ESG risks, as well as thinking about whether or not your IFRS 9 expected credit loss models need to include any kind of consideration for climate and ESG risks. Finally, it's around governance. So around all these policy updates, there should be some governance, right? Additional governance, second and third line support. And then finally, the last thing is about exit. So, it could be you have done all your due diligence and, you have a large line out, let's say $1 billion US to a corporate, and, they've gone through all your ESG scorecards and they've got a friendly score, but all of a sudden they become part of a merger and acquisition. And now that new entity introduces ESG risk. So how do you exit, for ESG reasons is another area that needs to be baked into the loan and policy process.
So we're looking at something that has a deep impact to every aspect of the bank's business. And from a technology perspective, I think a lot of the capabilities are available now to deal with this complexity. But of course, the implementation is something that is an additional challenge. So we're at time. We've had some great questions, which I think we're going to try and respond to via email. I want to thank Michael and Gemini very much for sharing with us such great information. 20 seconds, Gemini. Any final thoughts for the audience?
I think maybe a very quick one. So be open to the new topic. There are really a lot of knowledge bases and including some insightful databases from different organizations, of course, including IPCC, NGFS. Yeah, have an open mandate. There are a lot of new interesting points to be found out under the broader ESG topic for banks. And
Great,
also, yeah, and also last one. So now stress testing is still focusing on the ESG challenges under the risk management perspective, but actually the application of the results would be very helpful for the banks to negotiate for more ESG related opportunities with the regulator based on the solid risk management skills or framework they can show to the different regulators.
Very good. Thank you very much for that. And with that, just allow me to thank the audience for your attention. Have a good day.